Welcome back to the Deep Dive. Today we're plunging straight into something that, if you get it wrong, can really turn a smart-sounding tax move into a bit of a headache. We're talking about the IRS wash sale rule. Picture this. You're trying to use capital losses, to lower your tax bill, which you should be doing. But the IRS has this rule. It's basically designed to stop you from having your cake and eating it too, right? Claiming a loss while, well, essentially holding on to the same investment.
That's a perfect way to put it. So for everyone listening, our mission today is to go quite a bit beyond just the textbook definition. We really need to get into the nitty-gritty of that 60-day window, explain why the rule's even there, but critically focus on the strategy. We'll cover the pitfalls, like the basis adjustment, how it hits things like ETFs, and zero in on the really high-stakes traps. I'm talking about IRAs, where a disallowed loss can actually become a permanently forfeited loss. It's serious stuff.
Okay, let's start with the simple definition, because I think this is where some confusion creeps in right away. A wash sale happens when you sell a security stock, whatever, for a loss.
Right.
And then you buy back that same one, or one, and the IRS considers substantially identical within this specific time frame. It's 30 days before or 30 days after that sale.
That 60-day zone.
Exactly. Okay, let's unpack this. Why does the IRS even care about this? It seems kind of harmless on the surface.
Well, it really starts with the tax incentive itself. You got to understand the context.
Yeah.
U.S. tax law is actually pretty generous here. It lets investors take capital losses and use them to cancel out capital gains dollar for dollar.
Which is huge.
It is huge. And even better, if your losses are bigger than your gains for the year, you can take up to $3,000 of that excess loss and use it to reduce your regular income.
Like your salary.
Exactly. Reduce your ordinary income. And any loss beyond that, you can carry it forward to future years indefinitely. So there's a really strong incentive to, strategically take losses when you can.
It really is.
Yeah.
But investors, well, they figure things out, don't they? They realized you could kind of manufacture these losses without really changing your long-term plan.
Precisely. The IRS basically sees it as creating a paper loss. The specific thing they're trying to shut down is this. An investor sells something that's down, claims the loss immediately for the tax benefit.
Gets that deduction now.
Gets it now, and then turns right around, maybe the next day, maybe even later the same day, and buys the exact same thing back. So they're still holding it for the long term, but they've just snagged an immediate tax deduction along the way.
So if we connect this to the bigger picture, the rule is kind of like the IRS saying, hold on, if you really wanted to keep this thing, you didn't truly realize an economic loss yet.
That's the essence of it. You haven't changed your economic position in a meaningful way, so you don't get the tax break yet. So let's break down what actually makes it a wash sale. 3 things have to happen. 1, you sell security or get out of a contract at a genuine loss.
Okay, real money lost on that sale.
Yes. 2, that sale would, under normal rules, let you claim a capital loss to reduce your taxes.
Right.
And 3, this is the kicker, you buy back, or, acquire in some other way, a substantially identical security within 30 days before that sale or 30 days after that sale.
I wanted to jump in on that third point. In the original notes, there was some wording about buying it back at or below the sale price. That's not right, is it? The price you buy it back at doesn't actually matter for triggering the rule.
Excellent point. No, the price is completely irrelevant for deciding if it's a wash sale. If you sold stock A at $50 for a loss and then you buy it back within the window at $45 or even $55, it doesn't matter.
It's still a wash sale.
It's still a wash sale. The trigger is simply acquiring that identical or substantially identical security again within that 60-day time frame. The price you pay for the new shares only matters for the basis calculation later, which we'll get to. And just for a bit of global context, this isn't just a U.S. thing. In the U.K., they've had similar rules for ages. They used to call it bed and breakfasting. Sell it one day, buy it back the next morning. Tax authorities everywhere are wise to this one.
Okay, let's nail down this window. Because you hear 30 days, you hear 60 days. It gets confusing.
It does. The official rule focuses on the date you sell at a loss. The wash sale happens if you buy the replacement security either 30 calendar days before that sale, the day of the sale itself, or 30 calendar days after that sale. So when you add all that up, 30 before, the day of, 30 after you get this, 61-day period, really.
Yeah.
But people often just say the 60-day window.
Right, 30 on either side of the sale date. And the scope here isn't just plain old stocks, is it? It's much wider.
Oh, much wider. We're talking stocks, obviously, but also contracts, options, futures contracts, certain mutual funds, ETFs. It's broad.
So this means the risk is really amplified for anyone who trades actively.
Absolutely, particularly pattern day traders,
Yeah.
those executing lots of trades very quickly, they could accidentally trigger wash sales almost daily without careful tracking just because of the sheer volume and speed. It becomes a major compliance headache.
Here's where it gets really interesting.
Yeah.
For me, anyway. How does the IRS even know? What if I sell, say, Apple stock at a loss in my brokerage A account,
Mm-hmm.
and then 2 weeks later, I buy Apple stock back, but I do it in my brokerage B account? They don't talk to each other, do they?
Ah, that's a fantastic question. And it highlights, well, what used to be a bit of a loophole, but one the IRS is definitely aware of and expects you to handle. Right now, your brokerage A, in your example, they'll track wash sales within that single account. They have to. They'll report it on your form 1099B.
Okay.
But brokerage A has no idea what you did at brokerage B or in your spouse's account for that matter. The technology isn't there yet for them to consolidate across different firms.
So the burden is on
Right.
me.
100% on you, the taxpayer. You are legally required to track that 60-day window across all your accounts, taxable accounts, even potentially considering spouse's accounts depending on how you file. If you get audited, the IRS will expect you to have records showing you didn't violate the rule, regardless of where the trades happened.
Wow, okay. That sounds like a potential nightmare for people using multiple platforms.
Hmm.
Let's use that ABC XYZ stock example from the sources. It really clarifies the immediate pain of having that loss disallowed.
Yeah, let's walk through it slowly. Imagine you had a good year, you sold ABC stock and made a nice $15,000 capital gain. Great.
Nice problem to have.
Right. But you also had another investment, XYZ, that didn't do so well.
Good.
You sold XYZ and realized a $7,000 loss. Normally, you'd net those out, right? $15,000 gain minus $7,000 loss leaves you with an $8,000 net gain. You pay tax on $8,000.
Okay, that makes sense. Saving tax on that $7,000 difference.
Exactly. But what if you liked XYZ long-term? What if you bought XYZ stock back, or maybe an option on XYZ or something substantially identical within that 30-day window before or after selling it? Uh-oh.
Uh-oh is right. That $7,000 loss, poof, it's disallowed for this tax year. You cannot use it to offset the $15,000 gain.
So I pay tax on the full $15,000 gain now.
You pay tax on the full $15,000 gain now? The immediate tax benefit you were counting on from selling XYZ just vanished. This is why the rule really matters. It hits your current year's tax bill directly, even though, as we'll see, you might get credit for the loss later on.
Right. So the immediate hit is painful. You pay more tax today. But there's a bit of a silver lining, isn't there? At least in most cases. The loss isn't usually gone forever if the wash sale happened in a regular taxable brokerage account.
That's the absolutely crucial distinction. In a taxable account, it's typically a deferral, not a complete forfeiture. The disallowed loss isn't just erased.
So what happens to it?
It gets added to the cost basis of the new shares you just bought, the ones that triggered the wash sale rule.
Okay, walk me through that. Let's use numbers. Say I bought stock Z for $100. Later, it drops, and I sell it for $70. That's a $30 loss.
Right. $30 potential tax deduction. But then maybe the next day, I buy it back for $70 because I think it'll recover. Wash sale triggered. My $30 loss is disallowed for now.
Correct. But here's the adjustment. Those new shares you bought for $70, their cost basis isn't $70 anymore. The IRS makes you add the disallowed loss amount, that $30, to the purchase price. So $70 purchase price plus $30 disallowed loss gives you a new cost basis of $100 for those shares.
Ah, okay. So the basis is higher, which means if I hold those new shares for, say, a couple of years and then sell them for $110.
Then your taxable gain isn't calculated from the $70 you actually paid. It's calculated from the adjusted basis of $100.
So a $110 sale price minus $100 adjusted basis, only a $10 gain gets taxed.
Exactly. Instead of being taxed on a $40 gain, $110 minus the $70 purchase price, you're only taxed on $10, that $30 difference. That's you finally getting the tax benefit of the original $30 loss just later on.
So you do get credit for it eventually by reducing a future gain.
Precisely. The system ensures you get credit, just not necessarily when you first intended.
But hang on. This cost basis adjustment, while good, isn't totally risk-free from a strategy perspective, right? I mean, you're delaying when you get that tax benefit. What if? What if you're in a higher tax bracket years later when you finally sell the replacement shares?
That is the key strategic risk of this deferral. You've hit it exactly. You might have triggered that wash sale, disallowed the loss in a year when you were in, say, the 12% tax bracket. But maybe you sell the replacement shares 5 years later when you've had a great career jump and you're now in the 32% bracket. That $30 loss deduction is now offsetting income tax at a much higher rate.
Wait, wouldn't that be better? Saving tax at a higher rate?
Sorry, I flipped that. Let me rephrase. If you realize the loss now in a high-income year, it's worth more. If you defer it via a wash sale and then finally get the benefit by reducing a future gain in a year when you're in a lower tax bracket.
Ah, I see. You've effectively traded a high-value deduction today for a lower-value deduction tomorrow.
Exactly. The overall tax efficiency could be lower. It forces you to kind of guess your future financial situation, which is, let's be honest, pretty hard to do accurately.
Okay, that makes sense.
Yeah.
But there is one clear upside to this whole deferral thing. Besides eventually getting the loss recognized, it's about the holding period.
Yes, this is genuinely helpful. When a wash sale occurs and the basis is adjusted, the holding period of the original shares you sold at a loss gets tacked onto the holding period of the new shares you bought.
How does that help?
It helps you qualify for long-term capital gains treatment sooner. Remember, if you hold an asset for more than a year, any gain is taxed at the lower long-term capital gains rates, currently 0%, 15%, or 20%, depending on your income. Short-term gains, held a year or less, are taxed at your ordinary income rate, which is usually much higher. So, if selling the first batch of shares and immediately buying them back, triggering the wash sale, lets you add, say, 10 months of holding period to the new shares, you only need to hold the new ones for another 2 months plus a day to hit that 1-year mark for long-term treatment. It accelerates reaching that threshold.
That actually is a pretty significant benefit, especially for active traders.
It can be.
So, boiling it all down, the safest way to avoid this entirely, if you want that loss deduction now, is just wait.
Just wait. You have to wait until the 31st day after the date you sold the security at a loss before you buy it back. So if you sell on July 1st, don't touch it again until August 1st at the earliest. That creates a clean break. Okay, now let's pivot to the strategy that probably trips people up the most here, tax loss harvesting.
Right, selling losers to offset gains. It's standard advice.
It is standard and often good advice, but the trap is baked right in. People sell a loser, but they want to stay invested in that sector or asset class, right? So they immediately buy a replacement security.
And if that replacement is substantially identical, bam, wash sale.
Exactly. So the whole game becomes figuring out what counts as substantially identical. This is where it gets murky, especially for modern investors. Historically, maybe the discussion was, is preferred stock the same as common stock from the same company?
And the answer there is usually no, right?
Usually no. Bonds or preferred stock of company X are generally not seen as substantially identical to the common stock of company X. Though there are exceptions, like if the preferred stock is convertible into common stock easily and trades very similarly, that's less common for retail investors.
The bigger issue today, I think, is ETFs. This comes up constantly. Let's say I sell VOO, the Vanguard S&P 500 ETF, at a loss.
Very common ETF.
And then the next day, wanting to stay exposed to large-cap U.S. stocks, I buy IVV, the iShares S&P 500 ETF. They both track the S&P 500. Is that a wash sale?
That is the critical question for so many people right now. And the IRS guidance isn't perfectly explicit, but the general consensus among tax pros is be very careful. Even though VOO and IVV are technically different products from different companies, the IRS looks at the underlying substance. Do they track the exact same index?
Yes, S&P 500.
Do they have nearly identical holdings and performance because of that?
Pretty much, yeah.
Then there's a very high risk the IRS would consider them substantially identical, triggering the wash sale.
So just swapping one S&P 500 ETF for another S&P 500 ETF is probably not going to work for tax loss harvesting.
Probably not reliably, no. The safer strategy for tax loss harvesting, if you sell VOO, is to replace it with an ETF that tracks a different, though maybe correlated index. For example, maybe you buy an ETF tracking the entire U.S. stock market, like VTI, or maybe one tracking the Russell 1000 index, something similar, but not tracking the exact same benchmark.
Okay, that's super practical advice. Don't just swap tickers for the same index. Change the underlying index itself.
Exactly. But now we have to talk about the absolute biggest, most dangerous trap. The one where the loss isn't just deferred, it's gone forever.
This sounds bad.
It is. It's the IRA trap. It's officially covered in Revenue Ruling 2008-5T. This happens when you sell shares at a loss in your regular taxable brokerage account.
Okay.
And then, within that 30-day window, before or after, you buy the same or substantially identical shares inside an IRA or a Roth IRA.
Wait, the rule crosses over into retirement accounts? I thought those were separate tax worlds.
They are separate tax worlds, but the wash sale rule can still be triggered by that purchase inside the IRA. And here's the devastating part. Just like any wash sale, the loss you took in your taxable account is disallowed for that year. That's step one.
Okay, expected.
But step two is where it breaks. Remember how normally the disallowed loss increases the cost basis of the new shares?
Yeah, so you get it back later.
Well, cost basis inside an IRA is essentially irrelevant for tax purposes. Withdrawals are taxed based on other rules, pre-tax contributions, earnings, Roth rules, not on the basis of individual securities bought and sold within the account. So when the wash sale is triggered by an IRA purchase, the loss is disallowed in the taxable account, and there's no corresponding basis increase in the IRA.
So the disallowed loss just vanishes. It has nowhere to go.
It vanishes. It is permanently forfeited. You never get any tax benefit for that loss, ever.
Wow.
You get hit twice. You pay higher taxes now because the loss was disallowed, and D, you lose the value of that deduction completely. For anyone actively managing both taxable and retirement accounts, this is a landmine you absolutely have to avoid. Don't sell in taxable and immediately rebuy in your IRA.
That is critical to understand. We should probably also quickly mention the DRP trap dividend reinvestment plans.
Oh yeah, that's an easy one to miss. It seems harmless. Lots of people automatically reinvest dividends.
Yeah.
But let's say you sold 100 shares of Company Q at a loss on June 15th, but you forgot you had DRP turned on. On July 1st, Company Q pays a dividend, and your plan automatically buys, say, zero point 0.8 shares of Company Q with that dividend money.
That's within the 30 days after the sale.
It is. And even though it was automatic, even though it might be a tiny fractional share, you've technically acquired the same security within the window.
So the loss on the original 100 shares is disallowed, or maybe just part of it.
The loss corresponding to the number of shares repurchased, in this case 0.8 shares, would be disallowed, and its basis added to those tiny fractional shares. It complicates your record keeping significantly for potentially very little stock. Many people just turn off DRPs around the time they plan to harvest losses to avoid this hassle. Hashtag tag outro.
Okay, so let's try to wrap this up. We've covered a lot. The key takeaway seems to be wash sales aren't illegal, but they definitely have negative tax consequences right now, meaning you can't deduct that loss immediately. Understanding that 31-day waiting period is crucial if you want the immediate deduction. And knowing that usually in a taxable account, the loss is deferred via that cost basis adjustment, it's not totally lost.
Right. But this raises an important question. Given all this complexity we've discussed, tracking across multiple brokers, figuring out substantially identical for ETFs, and especially avoiding that permanent loss forfeiture with the IRA trap is aggressive tax loss harvesting always worth the effort. It really underscores the need, especially for active traders or those with complex situations, to potentially work with a financial professional, a CPA, someone who really gets the nuances here. It's easy to make a costly mistake. Err on the side of caution.
So what does this all mean? Well, here's something to think about after we sign off. Given that headache of tracking the 60-day window everywhere, and especially considering that really harsh IRA penalty where the loss is just gone forever, does it make you reconsider how aggressively you chase tax losses? Is the administrative burden and the risk, particularly if IRAs are involved, maybe not worth it unless the loss you're harvesting is truly substantial, something to mull over?